Hi back everyone. Welcome to this session. So we're continuing our lesson. Sorry for the delay. I was a little bit busy. Last time we talked about the difference between Gan swings and valid swings. So here we're going to continue from that point and go on to the other um, ideas and concepts. Um, uh, to review the previous lesson and also have a better understanding of the comparison between these two, I have just plotted both Gan swing and also valid swings here. So when we have noisy market, it is better to use valid swings. And when we have a neat and really easy to spot trend, we're going to use Gan swing. So for example, here, have a look at this chart. Now, have a look at this swing, which is Gan swing, but where the valid pullback swing or valid swing cannot detect it. And here also, it is recognizable by Gan swing, but it is not picked by valid swing. Okay. So here, also the same here, we have both of them have the same swing, so they're overlapping. But this one and this one is not detected again. And also this one and this one is not detected. So if we go and continue like this one, you will see that, sorry, you will see that the sensitivity of a valid swing is less than Gan swing, and Gan swing is so sensitive to price change. And the point is that we have to know where to use it. If you have watched the previous videos, you have to know that whenever you want to just use multi-time frames. So when it is your structured time frame, when it is your pattern time frame, it is better to use Gan swing. And when you're breaking down that Gan swing and you come down to the lower time frame, so it is better to use valid pullback because you want to just see exactly where our overbought or our sold area is. So, for example, here, have a look at this chart. Okay, now if we want to use a Gan swing to plot the leg here, so you will see that it is a clear and net and actually easy to see roadmap. Okay, so if we break it down, you can use valid swings here, and also you can use the pullback. Fibonacci retracement to identify the cycle of the market. But if you come here, so if you want to use Gan swing, so some of the parts here, okay, are neat, but if it is too much noisy and there is too much volatility in the market, you'll get confused. Now, the thing that I'm going to talk about today is not about Gan swings or valid pullback. Okay, so you have to just use one of these two. Okay, and do your back testing based on that, and you can use them interchangeably. Okay, so both of them can complete each other. They go hand in hand. Okay, whenever you just get confusion, so you can use a valid swing to confirm your Gan swing, or you can use Gan swing to confirm your valid swing direction. Okay, so it doesn't matter. Just if you use just one of them, it's okay as well. Now, the point of this lesson is that last time we talked about momentum of the legs and how we use this momentum in line with our structure to define our market cycle. So because in each market cycle, you have to use a special way of entering the chart, entering the trade. So for example, here we have a channel like in lower time frame, and in higher time frame, we have just green candles. They're going upwards, and we don't have any actually any pullback or any movement. Later, the momentum increases here. And if you remember when we were just checking the momentum based on the candles, so we were having first candle, two candles momentum, three candles momentum. Remember? So if you, for example, if we're in this candle, so this candle is closed in the last quarter. And if you compare these two candles, close of this candle is higher than the high of this candle. And if you want to compare these three candles, so the overlapping and the overlapping of the Fibonacci retracement is almost zero here. Look at this one. We have a little bit of 15% overlapping here, but here zero. Here we have 20%. Okay. So now today we want to use this system. We want to use the Fibonacci retracement to identify lower time frames, what? Market cycle. They go hand in hand with higher time frame market cycle, like momentum. When we have higher time frame leg momentum, if we just break it down into lower time frame, so we are going to have different scenarios of market cycle in the lower time frame. So have a look at this one. Here we have a movement up, we have pullback, it goes up again. Now, if we plot Fibonacci retracement, each of them are 25%. Okay, from here to there is 100% of the movement. So, and look, if we have the retracement, which goes even lower than the swing, it means that market structure changes, right? So we call this kind of market cycle choppy kind of actually market cycle. So it goes down, it just sweeps the liquidity below this valid swing or Gan swing, and it moves on and continues its way. And we call it a fake reversal or choppy one. Okay, maybe it is more than 120% what retracement. So is our market direction change? Has our market direction changed? No, because we are not defining our market direction using this time frame. Higher time frame is defining our market direction. Okay, our bias to buy. For example, if this happens in the uptrend, so we are still in the uptrend in the higher time frame. These movements up and down here equal. They all are equal to candles and legs in the higher time frame. So if you have a movement till here, okay, it doesn't pass through this swing. So it means it comes here and continues from there. So this time, our market cycle is going to be a sideway trading range. We call this differently, okay? Different masters, they call it differently. It doesn't matter whatever they call. So the idea is that it cannot pass through this swing. So if we just try to plot it, this swing and this swing, we have something horizontal. So we have a horizontal market cycle here. And if we have this one, like we have 75% of retracement and movement of the price, and it continues on, it is what weak channel. Okay, if we just connect this one to this swing, we will have a very weak, okay, momentum based on the trend line. So, and if we want to use this one, if this 50%, it is normal channel, right? Normal channel, and you can see it, okay? So, and if we have this one, like 25% or 30% retracement, we have a tight channel, so here, and we have a spike. So for 0% actually retracement means that it doesn't retrace at all. It means that it breaks out, right? So why are these important? Why do we just waste our time on these material? The point is that for each of these, we have different kinds of entry. You cannot behave the same way when our market cycle is like choppy or sideway, and you cannot do the same thing when it is tight channel or spike. Okay, in this spike phase, you can just maybe enter by close of the green here, green channel, green candle. But if it is like here, if you enter by close of the candle here, your stop will be taken out, right? So you cannot use the same kind of strategy for different kinds of market cycle. You have to choose between these market cycle and just work on one strategy for each market cycle. If you don't do that, you're gonna lose, and you will get confused. Why are you losing? Okay, all the time, because you haven't picked your market cycle. You have to work on market cycle, and my suggestion is that work on the market cycle which is choppy, sideway, or weak trend. Why? Because these three almost they are in a way that not only they give you higher risk to reward, or let's say reward that you get comparing to the risk you put is higher here, because whenever the price is going, it usually goes to this swing, which is made, okay, by price. Okay, so I'm going to talk about this reward to risk later. And if it is the, I mean, the 50%, 75%, 100%, and even the choppy ones are the best ones that they fall into overbought, oversold area of their actually market cycle. Here we also have overbought and oversold area. But if you remember, I said that usually 70% or even more than that is choppy or sideways. That's why trending, those traders that they trade in the trendy market cycle, they usually lose the money and they give the money back to the market when it is choppy or sideways cycle, because they don't have strategy for these areas, or they don't know when if it is trendy, because they think that it is continuing. But the point is that after the market cycle has happened, they realize that, oh, it was not trendy, so I shouldn't have traded, or I should have used market cycle strategy that aligns with this market cycle condition. So if we have the bearish scenario like this one, okay, and we are plotting our Fibonacci retracement, as I said, this is not standard Fibonacci. This is just a measurement that I'm just going to help you understand the market cycle here using this Fibonacci retracement. So here in the when we have a downtrend, in higher trend, we have downtrend and this swing. Sometimes this swing is taken out by this movement, and it continues back to the downtrend again. This itself, by itself, is one of the best strategies. Okay, they call it two-leg pullback, or Alberts call it second entry. So you're just, if you focus on this one, you're gonna get huge risk to reward to risk actually. So you enter here and you're just trying to target these areas, or 75% of these areas. So now it goes down, and we call it fake reversal, let's say, or fake outs. Okay, here you can use this time if it was Gan Swing, but your valid pullback is not formed yet. This valid pullback here helps you to identify your market cycle better and neater. Okay, but if one is making high, another one is not making high, there is something going on, right? So it's better to just work in a way that both your valid swing and your Gan swings are aligned. Or if you're just going to pick one, I suggest you to just pick valid pullback, because it is much actually neater, and although it is late, but it is neater to choose. So here now we have this scenario, trading range scenario, which happens here. Okay. Here we have weak swing, weak channel, sorry. So which happens here. And here we have normal channel. So it happens here, and high channel, what happens here. So you know the rest, it doesn't break, and it's almost identical, but in bearish scenario. Now, if we want to just compare reward of these entries to their risk, so have a look at this one. If we consider this red ones our risk amount, okay, so let's say that we are just risking $100. So you can take trades from here. So if here is 100, this one is at least 2 or 3 or 4 times bigger than this one. So if you can hunt this kind of trade, in long run, you're going to be profitable and you're going to have higher reward comparing to the risk you put. The same scenario here. If you're just working on the choppy markets, I mean that swings that they are swept, okay, although they have their own, ideas. So it is not just complete strategy here. But if you just focus on one market cycle, you get expert in that one, and you have created your own strategy based on that, although we're going to suggest some of them in the future. But I want to just understand the logic behind it. So here also is a good one. Okay, when you're using these two, they're almost using the same strategy, and if you just make some mistakes, it's okay. So it is not going to be disastrous. But if you just make slight mistakes here, so your stop loss will be taken out. So, and besides, because 75% and 80% of the, sometimes more than that, okay, sometimes 60, 70, 80% of market is sideway or choppy. And so why do you put your, let's say, eggs in a place that it doesn't give you a lot of profit here? And afterwards, if you just get the, some profitable ideas and you continue, you're going to lose them in this choppy markets, because you will realize that it is choppy and it is sideways after they're forming it. That's the reason that most of the traders lose, right? So now here, if you enter in 75%, okay, so let's say you're putting $100 here and you're getting at least 1.5 fold. And if you put your stop here, not behind there, because if you put your stop here, your reward will be less than your risk. So we don't want any reward less than 1. Okay. In long run, because of the mistakes you will make, you may lose the, actually you will get a negative expectancy. So the same stuff here. Okay. Now here it happens. It's just opposite of this idea. So here, if you just look at this one, so you put the Fibonacci, okay? Now, if in the other one, look, we are just plotting Fibonacci there. Here we have 50% of retracement, right? And this one, if from there, this swing to there, we don't have any 50% here, because this market cycle is a trendy market cycle. I mean, tight channel, if you consider it, right? Even here we have some spikes, right? But here, look, we have in this phase, okay, we have almost 50%. Here we have almost 50% retracement. Here we have 50% retracement. Now, again, here we have 50% retracement, although they look different here, but their retracements are 50%. Do we have 50% retracement here? No, we hardly get 25% retracement. So it means that it is a tight channel, right? Here we have 50%, even more, we have 75%. So a retracement, and it goes on 50% retracement. And here, because it has changed, right? So before it is changing, okay, we have here, we wanted to see 50%, 75%, or 100% retracement, or 125% retracement. So after you're entering there, you're just hoping to price goes up and up. So you're trying to get on the trend whenever it is just showing its hands, right? So you cannot trade in here, there, and that's why it is so difficult to catch the running market here. But usually 70%, 75, 70% of the market is like this, choppy and sideways. So you have to learn how to trade these stuff, right? And also it has a great risk to reward, okay? Now look, here we have 75% of retracement in the bearish scenario, right? Here we have this one, again, 50% retracement. Okay, now, so the point is that you have to just use higher time frames like momentum, and lower time frames swing market cycle momentum. Higher time frames like momentum creates a lower time frame swing market cycle. So I'm going to talk about zones in the next video, next lesson. So stay tuned. Have fun.